Hello and welcome to another one of our Macro Mondays. It is the 11th of November and we have lots to talk about, and there has been a lot of excitement in the market since Trump won the election. We've seen an unprecedented rise since Trump won, which is relatively understandable if you consider that there's less uncertainty in the market, but also there's a lot of optimism around what that could mean for the private sector in particular. I guess there's a general theme around reducing the government and deregulation, and lots of people are quite excited by the prospects of what this means. On Friday, we had the S&P 500 break 6,000, for the first time, making it to about $611 before closing the day at $5,995.54. So over the past year, the market is up, or the S&P 500 is up 35.79%. An incredible run, a run that we have not seen since the 50s. It is super interesting and something that I believe that a lot of people didn't expect. However, there have been some bulls out there that have been saying S&P 6,000 by the end of the year for some time now. Not only that, but of course, Bitcoin has performed extremely well. And I was looking at a couple of screens here before. Obviously, as of this moment, Bitcoin is at about $80,000. And we often hear about the prophecy of $100,000 in these bull runs. Every time we break through to these new all-time highs, we get a lot of optimism and a lot of speculation around the prospects of $100,000 per Bitcoin in US dollars. We seem to get optimism around the $100,000 mark. And then you also get more outlandish kind of price targets, $300,000, $500,000, $1 million from certain analysts and market pundits. What I would say here is, I would say it's very much a correlated trade with the equity market and the other parts of the market that are very optimistic about what Trump means for the economy, what Trump means for the private sector, and markets like it so far. When you look at the trends, we aren't at the level of kind of surge than we saw from that 2021 bull market and blow off top. We're kind of halfway there in terms of the interest over time, which has a couple of dynamics to it. One, perhaps there's more adoption of Bitcoin. People are more aware of it, so less people are searching at the stage. And of course, perhaps the hype hasn't reached its peak yet. But one thing that is for sure is that it definitely seems to be the case that Bitcoin is highly correlated with the S&P 500 and the NASDAQ. Depending on how the economy goes, will likely dictate how Bitcoin goes. Now to go into some of the flows that we've been observing, you can see here that over the past 4 weeks, we have seen the largest tech outflows since 2002. The index is not just tech, however, it's highly concentrated in technology. I believe it's over 30% of the index is in the top companies that are primarily tech, but then you have other companies that are amongst the S&P 500 as well. So that total allocation is very high, historically high, a level of concentration that we've not seen since 1929. But it's very interesting to observe that we are seeing lots of tech outflows while we are seeing huge inflows. Conversely to the outflows that we've seen in tech, we've seen huge inflows into the regional banks, small caps, and industrials. These three sectors are heavily affected by interest rates, and since the pendulum has swung towards a Trump win, so even before the election had happened, we were seeing a lot of people calling out that he was likely to win and what the consequences would be. And like in a traditional market fashion, market participants had been going into small caps, going into financials and regional banks, and of course also getting exposed to the industrial sector. These moves are not necessarily fundamental. They are driven off of sentiment and the idea of what a future Trump presidency could look like for the... Now that is in the face of interest rates going up as Trump was starting to win in the polls, win in the betting markets, and then subsequently winning in the election. There is a higher expectation of inflation now due to the policies that Trump has engendered. So we're not really sure what this means for interest rates and if there will be a lasting effect on interest rates when it comes to the long duration part of the yield curve. So your 10 years, 20 years, 30 years, with interest rates going up and the fact that we have quite a large maturity wall in 2025 and 2026. And what does that mean? That means that companies that are in the small cap space, regional banks, industrials, construction companies, commercial real estate, they all have interest rates that will likely be going up because they fixed their interest rates, let's say 5 years ago when interest rates were very, very low. And even with interest rates or the Federal Reserve cutting rates, we are still seeing interest rates, mortgages in the US and treasuries. Actually, those interest rates are going up again because of inflationary expectations. There's a bit of a tension between, lowering interest rates and the expectation of a potential resurgence of inflation. And that is actually quite a rational thought, considering if less people think that there's going to be a slowdown and that there is going to be a recession, then your expectation for future growth increases, and that could also lead to further inflation. So moving on to the Fed, continuing with their rate cut cycle, they went and cut another 25 basis points. It was a very brief conversation, straight to the point. We're cutting 25 basis points. It's a part of our plan, and they've kind of talked themselves into a corner here where they have to continue cutting because they've set that expectation. If they were to have paused, that would be extremely damaging, and the market would have likely reacted extremely poorly to that. So we got the 25 basis point cut. We have slightly moved in some of the narrative around inflation. We're talking less about potential slowing of the economy, although the underlying data that we're seeing, like the beige book, job numbers, and general leading economic indicators are trending towards a slowing economy, while the top line data, the GDP, and these companies in these large indexes are still posting great earnings results, and we still have a strong GDP. Now, I would say that there are two important parts to note here. The 85% of GDP growth in the US has come from the government, and we have just got a president in the US that is vowing to cut government spending dramatically and quote unquote drain the swamp. So, if that happened this year, 85% of that GDP growth would have been eradicated. And then two, being that a large proportion of the earnings growth in the S&P 500, I believe it's above 90%, has been driven by the hyperscalers, Nvidia, and tech at large. So that has to be something that we bear in mind, that a lot of the great data right now is perhaps hard to really get a good read on. Very similar to past cycles where things have seemed relatively strong, and then all of a sudden you see a deterioration. So there's always that sort of risk, especially when you're dealing with complex data sets and large systems. So we need to take everything that we read with a grain of salt, good or bad. Corporate bond confidence, and this is, I guess, consistent with where the S&P 500 is in a sense. So we've seen consumer sentiment rise slightly. We've got very tight spreads and strong corporate bond confidence now. Why have we seen corporate bond confidence? Well, we've seen that because we have seen the market go up, and the expectation of the Fed is, of course, that they are going to cut rates. When the expectation for rate cuts happen, then people that are going to go out and borrow money are expecting that they're going to have to pay lower interest rates. Unfortunately, so far, since Trump started to kind of gain momentum, we have seen interest rates rise. This is the highest level of confidence since 1998, just before the dot-com bust. So investors are risk on. Investors want to basically take this recent couple of years behind us and move forward, become more optimistic, and they want to see growth and a more prosperous environment. And Trump, I guess, represents that for a lot of people. And that is why we're seeing a swing away from government and a swing to private sector. We aren't sure what the consequences are, and we are also not sure if that's actually going to impact the fundamentals in the short term. Getting elected and having the policies that are going to engender a more productive and deregulated private sector doesn't happen overnight. And we have dealt with lots of interesting and rare events over the last couple of years, and we're still muddling our way through those. And of course, at the same time that we are talking about this, we have many assets. There's my dog. We have many assets at all-time highs, specifically primary indexes in the US. Certain emerging markets like India recently topped out and have started to draw down, but they reached all-time highs. Bitcoin, we're starting to see a resurgence from smaller cryptocurrencies as well on the back of Trump winning and the excitement around Bitcoin and Trump himself. And what happens in times of optimism and times of great performance in equities and other asset classes is that we get higher optimism. And I love markets, and I think the markets are a great tool for beating inflation, saving for retirement, and building wealth over time, whether that be through buying structured products, through indexes, funds, and so forth, ETFs. You can create portfolios that enable you an opportunity to outpace inflation. And then sometimes you get sentiment shifts around the potential of that growth. And at certain points in time, you make a lot more money in the short term. Things go up because there's a lot of excitement. Oftentimes, price appreciation comes and is driven by a shift in sentiment or, of course, less uncertainty. So the election happens, there is less uncertainty. We now know who the new president is. And then we may get more optimistic about the future. And because prices are going up, more people may get excited about it. But let's talk about the warnings around this thing, right? We're at all-time highs. Many more people are now being exposed to the opportunities that investing has to offer. However, whenever you get into something new, or when you ever get into something when there's a lot of excitement, try to mentally prepare yourself for lower expectations. We don't know what's going to happen in the market tomorrow. But what we can do is we can lower our own expectations around what that looks like. If Bitcoin has gone up 150% this year, I'm not sure on the exact number, I'm just throwing a number out there, then we shouldn't extrapolate those level of returns in a linear way. So for example, 150% every single year for the next 5 years. It's just highly unlikely. So I love when markets get exciting because more people get exposed to investing and the opportunity to build wealth and save. What I get concerned about is excitement leading to decisions that lead to large disappointments and then perhaps being put off of investing into the future if there is some volatility. Buffett often talks about if he was to be dollar cost averaging, he would use the S&P 500. But he's very specific in a lot of these quotes where he says that he would dollar cost average. So I think that the worst thing that could happen is potentially getting very excited and then going all in. That may not be the best approach according to Warren Buffett. So not advice from myself, but from what we've seen from some of the great investors like Buffett, is they love the concept, especially when it comes to index investing and long-term ETF investing. It comes down to oftentimes thinking about how can you spread your risk and dollar cost average. So it's awesome that more and more people are getting excited about the prospects of investing and the opportunities of building wealth outside of, for example, potentially real estate, especially for millennials that may not be looking to get into real estate or may struggle to get that deposit together. But what we want to make sure we do when times are exciting is we want to make sure that our expectations are in line with reality, or in line to a point where we won't get massively disappointed and find ourselves making poor decisions because we got overly excited and then things changed quickly. So I think it's really important to think about those things. Think about investing, read about investing, learn about finances, learn about improving your cash flow, and try not to get too caught up in the hype. As always, none of this is financial advice. These are my personal views and for entertainment and informational purposes only. None of what we talk about is giving buy, hold, or sell recommendations of any asset of any type. Learn about investing, learn about finances, learn about how you can improve your life and build your wealth, and try to use books and other resources and professionals to do so. So empower yourself, and we'll speak to you next time on our Macro Mondays.